Hi, and welcome to our end of November update from the Wealthy Doctor Institute. Physicians leading physicians through finance. We work with physicians and other busy professionals who are not happy with their current investment strategy. We help them get this part of their lives handled so they feel empowered and in control. I'm David Ye, and in my book, The Busy Doctor's Investment Guide, I show you just a few ways where just a few adjustments each year can help build and protect wealth. Although the strategies in this book are easy to calculate each month, for those of you who are new to the concepts in the book, or for those of you who are new to investing in general, this video will try to clarify what I do every month. Feel free to follow along every month until you get the hang of it. So this month we'll be reviewing our strategies, starting off with our safety belt systems, both the version I described in my book as well as the more sophisticated sector server strategy. And then we'll review the momentum rotation systems and see how we can combine those with our safety belt systems. Then we'll review our free sector server strategy that comes with any sector server subscription. Then we'll review the rules for the stock tip strategy for those of you who really have to buy certain stocks for some strange reason. So let's get started. We're reviewing our systems. Our first system is the 20-month simple moving average system, abbreviated to the 20-month SMA system. This is the system that I described in my book. It's a safety belt for investing in stock market in general. Remember that when markets do what markets do, they wiggle up and down, and they have major up and down trends. With a safety belt system, we can help mitigate most of the damage from a major crash, but we can't guarantee against all losses. All this does is increase our chances of surviving a market crash. So the rules are simple. If the S&P 500 Index Mutual Fund is above the 20-month moving average, which is easy to calculate, it's relatively safe to stay invested in the index fund, otherwise get out. The 20-month moving average is our safety belt if we look at it once a month, not more often, not less often. So here's a graphical representation of what I've been talking about. If you take a look at this jagged blue line, this is the graph of the S&P 500 Index Mutual Fund, corrected for dividends. And this red line is that 20-month moving average. You can see how when the blue line is above the red line, it tends to be relatively safe. Whereas when the blue line crosses below the red line, it tends to keep on going down for months to years, like how it did in 2000 and 2007. Now remember, people keep talking about the crash of 2008. We actually caught this in 2007 because of the safety belt. And for the end of this month, the S&P 500 kept going up, ended with a share value of $290.79 per share for the VFINX, which is the Vanguard version of the S&P 500 Index Mutual Fund. So if you take the 20-month moving average, that's also up to $261.22. And if you crunch the numbers, the share price divided by the moving average price, which you don't have to do, but I do anyway just to show you that by next month, if the stock market goes up, sideways, or even goes down up to 11.3%, it's still relatively safe to be in stock market right now. However, if next month crashes more than 11.3%, it's likely going to crash below a moving average, which would be a signal to get out. But we'll cross that bridge when we get to it next month. So here's Sector Server's version of the safety belt system. They call it Storm Guard Armor. And you can see we're switching between the same stock and bond mutual funds using this signal. And so far, this whole past month, we've been in stocks. There has been no new signal. It's still relatively safe to be in stock market according to Storm Guard Armor as well. So pick one of these systems and stick with it. Don't combine the two. Otherwise, if one gives one signal and the other one doesn't, you won't know what to do. And just as a graphical representation, here's Storm Guard Armor. You can see how it's still barely positive at 0.2%. Doesn't matter if it's small or large positive, it's positive. That means it's relatively safe to be in stock market. Now you can say that, well, it's so barely positive that it's still relatively dangerously safe, right? And you can say, yeah, in which case we'll watch next month to see if anything changes. Until things go negative with strong guard armor, it's relatively safe to be in stock market for this month. So our next system with the momentum rotation systems, if you remember my book, I used a system I call the monthly rotation investment system. There are many systems out there. Mine I call the MRI system, and if you recall, I no longer cover this particular system anymore. Once I discovered Sector Surfer's algorithm was more robust than the one published in my book. Even though it pains me as an author, my book MRI system is now obsolete, and I no longer cover it. Similarly, Sector Surfer's version of MRI, using the exact same three mutual funds I used to use, the S&P 500 Index Mutual Fund, the Emerging Markets Fund, and the Inverse S&P 500 Mutual Fund. If you plug these three into Sector Surfer and use their version of sector rotation, it tended to do better with less risk than the version published in my book. And even then, because of the addition of a safety belt system, I no longer even cover this version. So what is sector rotation? Well, if you take a look at this example, we have several mutual funds, including many U.S. stock mutual funds, including large cap, small cap, mid cap stocks, and international stocks like Total International Stock Market and Emerging Market Stock Market Index funds, and real estate fund, plus a long-term treasury bond fund. All this algorithm does is strip away the noise from the data. Once it does that, we get a better idea of which one of these is doing better at any one time, and we just hold that best fund that's best for that month. These will change on average around 4 times per year. So when the signal goes off, better make that change if you want to stick with the system. And by doing so, we can see that we can smooth out the losses that we saw in 2000 and 2007 and smooth out the curve somewhat. Now, if we were to combine this system with the safety belt system and take all the stock funds and rotate among those only, not the bond fund, only stock funds when the markets are relatively safe, and then rotate into bond fund when markets are relatively dangerous, then we get this system with a smoother graph, less volatility, relatively safer using statistical analysis. Having said that, Sector Surfer does come with a free strategy. So don't worry about signing up for a Sector Surfer. You're not going to get charged until you actually get a system that you like that's not free, that you really want to subscribe to. Problem with these free strategies that Sector Surfer comes with is that the free strategies usually use generic asset class mutual funds. They use an older version of StormGuard, and they do not separate stock from non-stock funds for rotation purposes. But if you like at least past performance and want to use this, it's free. This particular free strategy is called My ETF Asset Class. It's easy to look up on the website and subscribe to it. It consists of many of these generic broad market indexed ETFs and trades maybe 3 times per year and rotates into cash when it's relatively dangerous to be in the stock market. Again, this one is a free strategy, and this month there has been a trade signal. So let's look at how we place this trade. If we go to the Sector Surfer website, you scroll down to the row with your strategy. So here it is, My ETF Asset Class. There's a date with a red acknowledge trade button here. It says sell this and buy this. So go ahead and sell this and buy this in your brokerage, come back, Sector Surfer, and then you click on the red button, turning into a green button that says done with the date you did it. Now, Sector Surfer will stop emailing you and texting you until the next signal. Now, if you're anal like me, I check once a week, even though the signals come out once a month, just to make sure I don't miss any signals, but you don't have to. It's fairly reliable that you get these texts and emails if you set it up correctly, and especially if you only have 1 or 2 strategies running, this is definitely doable. So the next system we're covering is for when you absolutely positively have to buy a certain individual stock for some strange reason. I don't advocate that, only because stocks, besides all the other risks that we have in the stock market, also carries idiosyncratic risk. In other words, bad news about that one stock can tank that stock overnight, even when the rest of the sector is relatively okay. It's very hard to risk manage something like that without using more sophisticated strategies such as trailing stop losses, using options or futures. So to use this particular system, let's go over the rules. First, if you really want to buy the stock, limit the risk to only 1% of your portfolio or trading account. You do this by, if you're going to use a 25% trailing stop loss order, use up to 4% of your trading account to buy that stock. This way, if you lose 25% of this 4%, you only lose 1%. Get it? And then, if your stock actually goes up and goes up by 33%, now the stop loss order has gone up to where you originally bought the stock. In other words, it's a relatively risk-less position now. Now, go ahead and use another block of 4% of your account to buy another block of stock, and so on and so on. If it really goes to the moon and you have to do this 25 times, then eventually you have a whole account buying that one stock, but it's making a lot of money. But if this stock crashes on you, at least you've only lost 1% of your portfolio. And remember, every time you buy another block of stock, update your trailing stop loss order with the new number of shares, and just keep on doing this until you get stopped out. And you will eventually get stopped out. There is no such thing as a sure thing in the markets. So in summary, we've reviewed our systems, including our safety belt systems, and how we can incorporate momentum rotation systems with the safety belt systems to form new systems. We looked at the sample-free sector surfer strategy that comes with any sector surfer account, and then we reviewed our stock tip strategy. Keep those questions coming. I know I talk to several of you personally each month, and I realize that for some of you, these video updates are not enough. Especially if you're still unhappy with your current investing strategy or lack of strategy, I'm going to offer a complimentary investment wellness checkup session for you. Just you and me. Ask all the questions you want, no matter how seemingly basic or clueless you think you are. In our checkup session, we'll together create a sense of clarity about the financial future you really want, the reasons why you're investing to begin with, and I'll get you there, discuss investing building blocks that are more specific to your situation, and determine what has stopped you in the past from getting what you want now. Then we can identify what are the most important steps you need to take now to get to your investing and financial goals, and then complete our consultation with the excitement of knowing exactly what to do next to create that road to the future you really want. Think CME, only the topic is financial and tailored to you. Think wellness checkup, because whether or not you feel financially well, if you had a financial cancer or blind spot you didn't know about, wouldn't you rather at least know so you can deal with it before the problem grows and metastasizes? Don't be bashful reaching out. The more you delay, the more time is against you. So, until next month, invest safely.